Good afternoon, everybody. Welcome to your Monday edition of the TraderMerlin Show. A wild one out. Ooh, let me adjust my volume. There we go. Perfect. A wild one out there. Certainly some crazy moves happening, and you guys may have seen the thumbnail I did for today, which I know we've talked about a lot. You know, the U.S. dollar. All hail the king. Today was all about the dollar. I had people questioning or sending in questions saying, hey, is it about this? Or why the markets do that? It's the dollar and the dollar period. As Big Eb says, it's going to be hard to put that dollar genie back in the bottle. Absolutely. You know, when I asked this of my guest, David Warner, I asked this of my guest, Bill Addis, which is, how are you going to get that dollar to start to drop? And there were some other comments that came through, so I thought, let's just make a whole show about that dollar index and maybe improve some knowledge here for some of you who may not know about the dollar index, what it's constructed of, how it works, etc. So I'm going to start there. Everybody probably knows that the main component of that dollar index is the US dollar, the euro. Here, I made a little table for you. 57.6% of that dollar index is the euro. Now, I'm curious, what is the second heaviest weighted currency in the dollar index, and what percentage is it? Just curious, just for fun out there, let's just, get some chat going and see what people know about the dollar index, because we reference it so much on this program, and personally for me, I would say right now it's the lead piece for the market. If the dollar's going one direction, that's much more powerful than the equity markets if we have a currency leading. So we should obviously know as much as we can about that dollar index. So what's the second biggest component of it, and what percentage? Gary says British pound 20%. No. Surprisingly, no. You would think it would be. A lot of people do, but it's not the British pound. You would think because of the trading power of it and just the legacy, because they were the last reserve currency of the world, why not give them the power? Jay Patel is right. It's the Japanese yen. So let me start here and show you. Oh, I already got the top two. So they kind of jockey for a position. Tom says Dogecoin. Oh, don't give me. Why don't you throw Shiba Inu in there, Tom, to get me all fired up? There's your second and third place ratings. You have Japanese yen, 13.6%, British pound or pound sterling, 11.9%. So you can see why I have kind of an issue with the dollar index, because it's obvious that it's going to look pretty much the exact opposite of the euro, right? If the euro is over 50% of the index, then anytime we look at that at the dollar index, we should get kind of a Rorschach picture, which can be the exact opposite. And let me just show you here. Here's your dollar index. And this is a weekly going back into for the last 20 years. Let's go just back to last daily here, and commit this picture to memory. Going back to 2018, you had this nice uptrend, some zigzagging during the COVID pandemic when it initially hit. Dollars sold off a bit into 2021, and then since 2021, it has been absolutely nuclear, soaring, especially these last couple of weeks. So let's bring up a picture of the euro so you guys can see. And what should happen is this should be the exact opposite picture when we look at that euro. And lo and behold, I mean, it's a exact opposite, carbon copy. So it's a little, a little bias in my opinion to the euro. Yes, they're such a massive trading partner and a global powerhouse. However, let's spread it around a little bit. Now, here's where it gets interesting for me with the dollar index. Most people know it's got the euro, it's got the yen, it's got the pound, but there's three other ones on there. And I'm going to go to the next one just to give you one. I want to ask you this one, but we'll just let the chart show you. The Canadian dollar is about 9.1%. Now, after the Canadian dollar, all right, let's think around the world. I want everyone to think around the world of who would you say is a major financial or a major economic powerhouse that we should include there, right? You've already got the euro out of the way. You've got the British pound out of the way, Japanese yen and the Canadian dollar. Now, obviously, it's not going to be the Turkish lira, but what about the Australian dollar? What about the New Zealand dollar? Anybody in the market for sheep? You got New Zealand. What about the Mexican peso? There's a lot of big ones out there that should be a part of it. Well, Big Eb, Germany is still part of the euro. We're not going back to the Deutschmark anytime soon. Yeah, and that's why I kind of wanted to ask this question, because I think a lot of you are going to say, yeah, what about the Australian dollar? And some of you know what is the next two components, but I just question it. I go, really? how I don't know when the last time this dollar index was adjusted. It came about in 1967 is when they really kind of built this dollar index, and I'm sure it's been modified a little bit. Zed, that's a good question. What about the yuan, right? Unfortunately, I don't think the yuan will ever make it in here because it is just outright manipulated. Now, it would be hypocritical for me to say that the dollar is not manipulated, right? I'm pretty sure we'd all agree that the dollar's manipulated. The ruble, I think just out of protest against Russia and Putin right now, they would make sure that the ruble's not in there just to say, screw you, Putin. So let's go down the list here. I thought that this next one just kind of blows my mind. I'm pretty sure that everybody here can identify one company. And if you can get two, you're doing pretty good. If you get three companies that are from this country that are publicly traded, you're going to be like, okay, you're doing well. Let's go into the next one. It is the Swedish krona. I'm going to let that one just hang in the air for a second. The Swedish krona. Okay, so what do we have from Sweden? Right? What's the amazing thing that comes from Sweden other than tall, blonde ladies with light-colored eyes? Obviously, when you look at Swedish, you have IKEA, global powerhouse. But, I run through and I'm looking at all the different companies and products and major things. There are definitely some other companies there, and I'm sure I'm going to get some through here. Volvo, yep, Volvo, and IKEA. Those are pretty much the two that we all think of, right? I mean, IKEA, smart. They took all the Swedish krona colors and awesome, good for you. Michael says the women. And the women could probably say the Swedish men, too. They're all these tall and anyway, we won't even go there. Oh, there you go, Pepper. I like that. Meatballs. But Volvo and IKEA are like their two staples. Now, you might say that there's maybe some vodka from that. I don't really think there is. But what else comes from Sweden? I don't know. Cross-country skiing. Amazing sports athletes in the winter. Don't get me wrong. I love Sweden. I just wonder, is there a better suited fit in this dollar index? So now let's go to the last one, which some of you have already guessed this one. And that is the Swiss franc. Now, I think that the Swiss franc in there personally is there as a neutral player because Swiss never take sides. They got a stable financial system. But, are we looking at watches, Swiss Army knives, and chocolate? To me, not the best economy in the world. I certainly would put Australia in there above Sweden or Swiss franc. And, I find surprising that nothing from South America or Latin America is represented in this picture. So anyway, I thought I would throw that out there just so you guys know what makes up this index that we reference so often on the program. Is Zlatan Ibrahimovic, I think he lives in Sweden. I don't think he was born Swedish because I assure you that Ibrahimovic is not a Swedish surname. I'm going to go out on a limb there and say I'm pretty sure, I'll take that bet, that Zlatan Ibrahimovic is not a Swedish native. All right, so cool. Cross-country skiing, hockey, yeah, they're great at that, but that's not an export, right? That's not really an export. Anyway, I'm belaboring the point here. I thought it would be interesting just for you guys to see. That is 100% of the index there. The euro is making a 57.6, Japanese yen 13.6, British pound sterling 11.9, Canadian dollar 9.1, Swedish krona 4.2, and finally the Swiss franc at 3.6%. Okay, so now that I got that out of the way, let's jump over to the chart and show you. I've been talking about these levels for quite some time, and we talked about this 103.50 mark. I said if we get to 103.50, you're looking at 106 as your next stop. And then it was kind of like we have a huge jump from 106 all the way to 113.50, and I thought we would take a little bit longer to get there, but boy, look at this. I mean, we hit over 114 today. Holy shnikes. I mean, we had a high, not all-time high, of 114.52. So I'm going to make this a weekly chart. Actually, I'll leave it as a daily, and I apologize because I'm going to have to do a lot of scrolling, but I just want you guys to see as I scroll back here how far back we have to go. It literally is 20 years. So here are some of the other zones we've been looking at. That 105.20, you had some right around 106.50. There was some hesitation here around 108, and then I've been saying 113.50. And the main reason for that, if we zoom in right here, this goes all the way back into 2002. Picture a time and place. And remember where you were back in 2002. Right? I agree with you, Joe. Zoinks! Raggy. The reason I chose that 113.50 is you had this big sell-off moment. It based for a little bit. Yeah, it was kind of choppy for a while. But when it broke, it was the beginning of just a gigantic downslide in that dollar index. So that was the next target for me. Now, at this point, I guess we really have to start looking forward and saying, well, where's the next one? right? So I think if I'm going to be true David Warner fashion, I've got to look at that 115 or 115 and a quarter. Probably better to do 115 and a quarter because it's right near the highs at this one we saw on May 15, 2002. You can trade the dollar index. There's dollar futures. But generally indexes you can't trade. There's usually some derivative or ETF product that will represent that. And then, for after that, where do we look? These don't look that great. The 116.50 mark, we could use that as a supply zone, but I don't see anything in here that's really screaming at me other than maybe the 119. And if you're going 119, well, you may as well just round up and call it 120. Now, that said, let's bring this back to a weekly. I've been saying pretty clearly, I think, on this show that if this dollar keeps going, it's pain for the market. We are in trouble if this keeps going. And I did not expect this sudden of a move. I mean, in 2 weeks, we've gone from 108 to 114. Again, this is the global purchasing power of the U.S. dollar in 2 weeks has gained 6.22%. I mean, it's one thing for Apple to move 6.22% or, Goldman Sachs or Wells Fargo, but the entire dollar purchasing power around the world, that is astounding how much that's moved. So my gut tells me that we're probably, and this is just my gut, I've been wrong a bunch lately, is that we'll probably have a little bit of a reprieve. Right now it feels like everything is pouring into the dollar and pushing that even higher and higher. Now, we'll talk a little bit here about whether that's good for an economy overall or bad for the economy. What'd you say here, Joe? The demand for dollar is only going to increase from here. Yep, the entire world is using it to hedge against inflation. Not only hedge against inflation, but to get yield, right? They're trying to get yield by holding U.S. dollars or buying U.S. bonds, which we saw some pretty nice surges today. Boy, did anybody in here lock in their loans in the last 6 months? Just if you did, just say yes. Did you lock in a loan in the last a 30-year fixed rate mortgage, for example, in the last 6 months? If you did, you're probably going, damn, I paid a lot more because if I got one in November, I could have gotten under 3%. Today, holy cow! Check this one out. Let me scroll down here, look at the 10-year real quick, just to hit home or punch some people in the gut. Here's our 10-year. The 10-year today, it actually rolled over. We were up huge on the 10-year today. 3.92 is where we closed at on the 10-year. Just to put that into perspective, I've been saying that the dollar or the 10-year is going to keep rising because the Fed funds rate's rising. They're saying another 1.25% by the end of the year, which could push our 10-year up to roughly, 5.25. If we get a 5.25% 10-year, you're looking at 7 or 8% 30-year fixed rate mortgages. So for those of you who locked in, good for you. Great. Historically, you're still looking at a great rate. And you're going to look back in 6 months or a year and go, oh my goodness, I'm so lucky I locked in at 5, 4, 6%. If this keeps going, you're looking at 8, 9% mortgages within the very short period of time. So I want everyone to think of how badly that itself is going to impact the housing market. What percent of mortgages loans are variable? That I don't know, Sava, but this is one thing that's pretty important. We can get drawn into locking. When you're buying a home, obviously you look at the two rates. You go, I can get a fixed rate or a variable rate, and the variable rate is generally going to be a lower yield or lower mortgage payment. And you're like, I'll do that. But if you're buying a home and you buy with a variable rate mortgage and the rates are going up, that's on you. I mean, that could potentially cause you to lose your home. Now, if it's a market that's falling and it's a declining rate environment like we saw for the last few years, okay, that's fine. But again, always go with the trend. And at this point, there's no argument. This trend is aggressively to the upside. Again, all hail the king. Now, to really, my brother locked in last year at 2.9. Nice. Yeah, it's funny. So my father's a real estate agent, right? And I know loans, I know mortgage, I know lending, I know buying homes, but I refinanced mine, I think it was 2016, so a few years back. And I went from a 30-year fixed rate to better get off me, mosquito, 30-year fixed rate mortgage to a 15. And I locked in a 15-year at 2.875. And it was one of those, when I locked it and I got confirmation, I was just like, pounding my chest, feeling like King Kong. I thought I got the greatest deal. Even my dad was like, man, I've never seen him that low. And of course, a year or so later, you could have gotten a 30-year fixed rate at 2.75. I mean, that is insane. So, what's normal for mortgages? I don't know. I would say you get to the 5, 6, 7% range. That's probably historically normal. Nice, Chris. Good for you, man. You know, and it's funny because a lot of people look at this and say housing prices are going to fall. And if you know you're going to stay in your home and live there, then it's not that bad of a deal if prices fall a little bit. Because you know you're locked in at 2 or 3. Fine. You know, expect to have a little bit of a drop. Even 5% I think is okay historical long term. But because they're fighting this inflation issue, it's going to get much higher than that. I'm willing to bet you that by the end of, well, by middle of next year, we'll have 8% 30-year fixed rate mortgages. At least, maybe even more. 7.6 is the average. Wow, thanks, Big Eb. Really? That's, God, somehow that does seem a little bit high. I would say like 5 or 6. So we're still below historical averages then, based off what Big Eb has provided here. Thank you for the data. I appreciate that. Cool, but we'll be above that. I'm almost certain of it. Now let's go look at some other things. So you guys know, Monday, Tuesday, Wednesday of this week, I'm doing shows, and then I'm off for 2+ weeks. So I'm sorry. No Trader Merlin to, I don't know, to entertain you for the next couple of weeks. You have to do on your own. But let's go look at that British pound because you guys know I'm headed over to Europe. The euro had a great day today, and I mean that sarcastically. It imploded. But let me go to the British pound since it's the lowest level it has ever been in my lifetime. In all the charts I could find, I can't find anything that shows me past 1983. And today, that British pound fell all the way down to 103.56. It's never been below 105. Like, holy cow. I mean, and I was joking about that. Not really joking, but when we were at 114, I said, you know, what's the probability of us getting to parity? If the dollar keeps going, that British pound could be at parity by the end of the week. I mean, look how quickly this thing's fallen on a weekly time frame. That is insane. Now, it bounced today. You got a nice big hammer forming. But let's go back to the monthly and just show you those all-time lows. Now, we hit those all-time lows today. The all-time low previously was 105.20, and today we broke that. So anybody that's in the UK, this is it's great for your exports, right? It's great for your exports, but it's not good for the citizens there to have such a weak currency. Now the dollar, obviously this is impacting us because the more that we see this thing spike up, the worse impact it's going to have on the equity markets. So I'm going to start there. Well, not start, we've been going, but let's start with things that are hurt by rising prices. Commodities, again, huge move up today in that dollar index. So what do you think is going to suffer? Gold was down, silver was down, and crude oil got kicked in the teeth today. That's a monthly. Here's your daily of crude oil. Doesn't look bad when it's scaled like that, but when you look there, I mean, we talked about going with that trend. It pulled back right up in that 90.18 mark, which was the area of supply, sold off, and now it's seeking a new floor. Question is, where's that floor going to be? My guess is just based off this area of consolidation back to December of 2021, you're probably looking about 75.50, which would be about another 80 cents lower from where we are at today. After that, you know, you're looking down around 68, then you're looking all the way down to these lows right around 64. So we could see oil prices continue to drop a lot more. Do a travel channel, Iron King. I'm going to be trying to enjoy life, and I'm going to probably not be doing any broadcasts while I'm there. But I might do something, who knows. But probably not. I'm going to try to disappear and enjoy life and not think about markets for a while. So there's your crude oil chart for the day, down 3.05%. Ugly. Gold down 1.59%. You know, a couple weeks ago, even though I am long gold and I'm selling calls against it because I'm okay to hold gold long term, you know, we talked about the probability is higher that gold is going to be going down. Why? Well, the trend is down. It broke down below support, and the dollar is surging. And my guess is that's going to continue. The question is, where does it ultimately go to? Right now, you're at 16.29 on gold, and the only thing that I see that's even remotely interesting, and it's not even that interesting, is this drop one-day base and rip out that is right around 15.90. So let me move this line here, or put a line at 15.90. I mean, there's a lot of readjustments got to be going on with portfolios, and it's just Thomasina, I'm not going to say I'm not thinking about you. I'm just trying not to think about markets. I'm just trying to think about being a tourist for a while. So there's where I think we're headed with gold. Not the best for anybody who's long gold, but that's just what I got on the charts. You know, charts don't lie, and there's nothing to hold it up right now. Russell 2000 was also down 1.41%. Now, what makes the Russell better than some of these other indexes is it still hasn't broken this low at 1640, which I talked about on Friday's show. However, we retested Friday's lows, and we're screaming towards that 1640 level. So we probably going to hit that this week. I'm going to go out on a limb and say there's going to be a little bit of a bounce. It feels like this is just too overdone. I mean, you've had 1, 2, 3, 4, 5 down days on the Russell. Not that that's out of the ordinary. It's the magnitude of those 5 down days from peak to trough. For those last 5 days, the Russell is down 9.5%. Ouch. And NASDAQ is pretty much the same. Here's your Dow. So I thank you, Iron King. I will definitely enjoy my vacation. I will absolutely enjoy some time away. So as I mentioned, the Russell, right, it's coming into this demand zone, or at least the lows. I don't know if I necessarily would call this a demand, but the lows from June 15th, essentially. Look at the Dow. Dow broke, right? We kind of held on to it with the close on Friday. Dow broke down below that. It's only down 1.12%, but it's below that level now, which means it's going to have to seek out a new area of buyers. And where are they going to be at? I don't really see any until you get way down here to 26,000. It's talking another 3,000 points down. That's a 10% drop from current levels to get to a strong area of demand, in my opinion. S&P 500 was also down about 1.12%. It's doing just what the Russell did, which is holding right at those lows. So for anybody who's bullish and hoping for a little bit of a rally, you're praying right now that these levels hold for the broad market indexes, especially especially the S&P, and I'll bring up your NASDAQ right here, which is also right into that area of demand. So we're kind of dancing on the edge of a cliff here for the major indexes. If the NASDAQ and S&P hold, then we'll probably see a nice little move back up and recoup some of these losses. If it doesn't, I expect actually a very aggressive move to the downside if it breaks. If it breaks it, I think you're going to get one of those shock white black swan type of events where people start freaking out. We already have a lot of pain in that market. Going back to this NASDAQ just a couple of weeks ago, let's go back to August, right? So let's talk 1 month worth of trading. Go August to September, pretty much 20 days. If you look at from peak to trough, it's down 18%. So there's pain out there. And NJ says, wow, the VIX. Well, you know what? To be honest, the VIX still is not reflecting pain. Pain is when you get over 40, that means that people are in pain. Those are the historical parameters for VIX. There's an old mantra that says when VIX is high, it's time to buy. When VIX is low, it's time to go. Well, notice I got these 2 blue lines here. You're kind of middle of the range, right? Where it's been before. So I don't even think pain is set in yet. Sorry to say it. It sounds awful to say it. However, I don't think pain is there yet. If we start to see these markets really fall, and here's the scenario I think may play out. I apologize for sounding like doom and gloom, but if the S&P breaks these lows, which are roughly, let's call it, let's say it gets below 3,600. Okay, if the S&P gets below 3,600, really 3,650, if it gets closed below 3,650-ish, then all of a sudden it's going to trigger sell orders. When the sell orders start to trigger, that's going to cause people to run to try to buy a bunch of puts, which is going to spike the VIX index. If that VIX gets above 40, then we can look at that mantra. When VIX is high, time to buy. Well, just because the VIX goes over 40, I want everyone to memorize this and remember if and when it does happen. If the VIX gets over 40, that does not mean you need to buy. I would yell this at you right now. It does not mean that you need to buy. It just means that based off historical data, we've had a significant sharp move in the market, and historically that's a good place to buy. And the reason I say I would shout it at you is look back here into 2020. When VIX broke 40, that was in February, and it just kept going. I mean, we ended up hitting 85 on the VIX. And if you were trying to buy this whole way, you would have been liquidated. You'd have been margined out. You'd have been shut. Your account would have been blown out, right? Multiple times it's done this where it's gone well above 40 and kept going. Now, let's say VIX does get above 40, right? Let's just assume the S&P sold off, and all of a sudden it goes into a really heavy slide, and then you have the VIX pop above 40. I'm curious to know what you guys would do. I just painted a scenario for you. The VIX surged, right? It gets up above 40, which is that mantra, VIX is high, time to buy, meaning buy the market, although stop and recalibrate here. You have the S&P is in a really sharp sell-off and volume is spiking. What would be probably the most logical action to do? How would you play that? All right, I'm just curious to see. It's a pop quiz here. You're faced with a situation where VIX is spiked aggressively over 40. markets are in that point, they'd probably be in a pretty good free fall. Like we're talking 10% down over the next, in 2 or 3 days. Sharp drops on very high volume. What would you be looking for? I can tell you very specifically what I would be looking for. Sava says, look for demand zones. Oh, Sava, don't take it away, bud. Don't take that away. You were doing good. That's what I wanted. There is no real wrong answer, and I'm never gonna yell at you for doing something bad. Tom says, short the VIX and buy puts. Okay, you'd be getting huge premium for selling puts, and Tom, you'd be paying huge premium for buying those puts. Wait till it comes back under 40 for the VIX. Tim Blatzer used to say VIX is high and turns down, time to buy. Yep. Our 401ks and IRAs FDIC insured. Yeah, no, they're SIPC insured because they're securities. So cash is going to be FDIC. Securities will be SIPC. Looking at 60-day out calls. Okay, maybe spreads. Okay, follow the trend. Here's what I do. Be real simple. I look at these price charts, and if I saw that VIX surge, and let's say I'll put a line on here, it does this. Bam! And all of a sudden VIX is up here. That does not mean I'm going to be out there looking to buy right away. I'm not looking to buy. However, this tells you that people are panicking. When VIX is above 40, that's really what it's indicating. It's called a fear gauge for a reason. That means that people are very fearful. Something above 40 would be good. I saw a comment there from Tom from Big Eb saying 45 is kind of that sweet spot to buy historically. Fine. I'd be fine to even move this line up to 45. At least you put a line in the sand and you say, okay, if it breaks that, now I'm interested. Let me deploy a strategy. So what I would do is I would look at this VIX index. If that's over 45 or 40, pick your number, I'd be looking at this S&P 500. And if that happened, the S&P most likely is going to have a move that looks like this. Then I'm going to be looking and saying, all right, well, are there demand zones that I'm interested in? Right? Because at this point, you are absolutely catching a falling knife, which is a dangerous thing. So maybe what I would be doing is I'd be selling puts because the premium I would be getting for these puts is going to be huge because people are panicking. They're paying arms and legs for the puts. And I'm like, okay, it's 110 degrees outside. You want to buy ice cubes? I got a whole cooler of it. I'll sell you more ice. The biggest risk that would happen to me is this thing all of a sudden rips down even more and I get executed. But let's just go like SPY because that's generally what I trade. I know, Tom, you do SPX. But, if we have a big sell-off here, you just have to look at it and say, where would I be interested in potentially buying this if that chart looks like this and VIX is spiking? Well, I would come up with some levels and say, you know what, am I okay owning the SPY down here at 275? All right, yeah, I probably would be okay there. Am I fine owning it down here at 245? Sure. Am I fine owning it at 217? Sure. Right? Catching a falling knife is my middle name. Catching a falling knife is not a problem. The problem is people try to catch it before it hits demand. So if I can find a strong demand zone, and I'll be honest, I don't see any really strong demand zones. I do like the 245 mark just because the way it shot up, aggressive move down, and then ripped up. So, if it starts to sell like that, I'll go out there and maybe sell the 245s, the 275s, as long as there's enough premium to make it worth the risk that I'm taking. In essence, what you're doing is you're taking advantage of people that are in pain. And it's a good thing because you are offering them comfort. When that market drops and it starts to tank, people are going to freak out. They're going to try to buy as many puts as they can to hedge their positions, hedge their portfolios. And you're going, okay, I will help you. Sir, ma'am, I understand your pain, your strife, your struggles. It's brutal out there. I'll help you because I'm willing to buy this thing at 245. So, and I'm okay to hold that for the long haul. So that's in a dramatic way how I'd be playing it. I know we all have different approaches, and I know some of you guys are doing spreads and things like that. Awesome. The Becton says, catch a falling knife when it hits the floor. Exactly. And that's what I'm saying, Big Eb. Catching a falling knife, if it hits a demand zone, you're calling that the floor, or what you feel is a floor, right? We never know for certain if that is in fact going to hold and be the floor that stops price from going down any further. But, let's just say I have these two numbers I'm looking at, the 245 and the 275. Off the all-time high, 275 would be a 42% slide. 245s would be almost a 49% slide. Historically, you don't see moves that are greater than 50%, right? We saw them back here. If I go to the weekly, we saw a 50% slide from 2000 to 2003, and we saw a 54% slide from 2007 to 2009. And I absolutely think it's possible for us to get a 50% slide here as well. Now, if we do get a 50% slide, I guess I could draw a yellow box that would look something like that. And that's probably, ultimately, I think what will happen by next year, I think we'll probably be down around that 217 on the SPY. But that is, doom and gloom. I know a lot of people are like, you're crazy, Merlin, that'll never happen. And that makes me even more confident that it will. If everyone's saying it's not going to happen, that's most likely what will. Just like we talked about that British pound today, or last week. Could it get to parity? People are like, no, that's not going to happen. And I go, it's a real possibility. It's a real possibility. So I love it. I love where things are going. I know it's pain for many of you. If you are long, you either better be hedging your positions or go to cash. Or if you want to play it outright, go short. Just remember, when we get these really strong parabolic moves, either up or down, like we see here on the British pound, when you see this, it looks inviting to jump on it short. However, what will probably happen on that British pound USD is it will probably spike back up. It usually does. When you get this capitulation, climactic, fear, that's usually when things rip back to the upside. If you look at today, bring up the S&P, throw on some volume on here. We haven't really had a climactic moment, have we? Notice the volume. It's higher than normal volume, which represents fear, but it's not climactic. A climactic volume would be something that's like double normal volume, and that's that moment where everybody just craps the bed at the same time. Well, we haven't had that. Been short New Zealand dollar for a month now. Nice. Looking good to you. And actually, it's funny. We talk about capitulation. Notice this one right here. Right? This, to me, would be a climactic moment. If I had this chart right here, I'd be saying, hey, we're ready for a bounce. This thing's going to bounce to the upside. Just because look how much everyone panicked. And I would have been wrong. That one just kept on drifting lower and lower and lower. Hey, Ron, good to see you. Order 401k. Go to stable fund. Yep. Yeah, 401ks won't let you go to cash. That's true. They usually have a money market fund or what they'll call a safe bond. A short-term bond fund. So you could go to like a 1 year or short-term bond product. But yeah, they won't let you go to cash, which is so ridiculous. They want your money in an asset that they can charge you fees on. It's like, as much as we tout 401ks as being such a great vehicle, man, they are almost, a scam. But as long as you get matching, if you don't get matching from your employer on your 401k, personally, I don't think you should be doing a 401k unless it's a major, important tax benefit for you of doing it. Look at that USD. Oh, hey, good, Drew. I'm glad it helps. That's why we're all here. It's not just me. We've got others here that contribute to it as well. So, yep, you are definitely fighting that downtrend. But if I'm going long, I'd be fighting that downtrend. At this point, I'm a little disappointed I closed out some of my puts. I had XLB, and I closed that one out, and look where you had a nice fall through today. But I'm very happy with the profit I made on my XLB. It offset a bunch of my losses, so great. Now I just got to I cleared out some of my positions today. I'm keeping some of my my put options. We'll see how that all transpires. I do have some 64 puts on XLE that I sold, which we'll see if those hit by October. But a lot of action. No anxiety for me, Chase. Where are we at on the Wall Street cheat sheet, psychology of a marketplace chart? I'm not sure what the Wall Street cheat sheet means. I'm not sure what you're talking about there. People also sell calls against long stock positions. We could see that at volume. Yeah, peasant, and that's one thing I do. I'm a huge fan of it. Like if I have positions, which I do right now, I'm selling calls on it. And normally what I'll do is I sell it higher with the expectation the price is going to move up because historically markets are bullish, right? And we'll move up. But lately what I've been doing is I will sell those calls at the money or maybe even just out of it a little bit and get huge premium because I'm anticipating prices falling and I'm just dollar cost averaging. And some of you would say, well, why don't you just sell the long positions and chalk it up and take a loss? Well, I'll hopefully offset it by the premium I'm collecting on those options and then those call options against my position. And then ultimately I'm dollar cost average into a much, much, much lower price. All right, what else we got here? A whole bunch of, I'd be okay buying at 2,300. Yeah. But the key, Joe says I'd be okay buying at 2,300. Of course, we're referencing the S&P. The key is you got to have money when you get there, right? I know a lot of people look at this weekly chart of the S&P, and if the equity markets fell all the way down here, let's say 2,400 on the S&P, a lot of people won't have money because they've been holding long and they've been buying more as this market rallies up, and now all of a sudden it turned, it's rolling over and looking real negative. Don't have a lot of cash. Right? Where are you going to get the cash? Are you going to pull it out of your house? No, you're not. Most people aren't going to be able to do that because the mortgage rates are going to be so damn high and the housing market will probably be in turmoil. So, the perfect storm cloudy skies, and all hail the king, the dollar. All right. XLV closed my puts today too. Nice. We have a Roth with match. Yeah, and that's the key, Saba. If they match, then you get that free rate of return. If they match 1-to-1, it's 100% rate of return. Of course, do it, right? Do whatever the maximum is that they will match you on. Other than that, I would say you're probably better to go into self-directed IRA where you can put it in what you want. You want to go to cash? Snap your fingers, you're back in cash. Whereas mutual funds, 401ks, quite often they limit the number of transactions you can make per year. They'll charge you fees on everything. The mutual funds have fees. The fund has fees. There's fees on top of fees. There's so many fees you think you need to get a flea medicine just to deal with them all. Everybody spoke about inverse ETFs. Would you take a non-leveraged one when you can't short? Yes. A non-leveraged one, I think you're okay. So like, for example, if you're looking at shorting the market but you can't go short, let's say you wanted to go short SPY. Here is the weekly. Let's go to a daily. You could just, instead of shorting SPY, which you may not be able to in certain accounts, you could buy SH. And SH is itself short, 1-to-1 the S&P 500. Now, this is going to have a higher fee than SPY. However, it's still probably the safer way to go. I would stay away from the triple leverage, double leverage stuff, unless you're trying just for a couple days, maybe a week or two. But long term, those just eat away at your profits. It's unfortunate, but work at a record-keeping company. It's all fee. Yeah, it is. It's all fees, man. I have to pay fees just to pay my fees. Will we have a soft landing? No. Let me see if I can. I don't know if I can actually do this legally. We'll see. Will we have a? Here, you want to see the saw? I was going to show you one. I was going to actually go into YouTube and find a picture of a plane crash just to see if I could reenact what it might look like for us. But yeah, I don't think we're going to have a soft landing. I think it's going to be pretty aggressive. Bad. I think it looks something maybe maybe like this. You're like, oh, it's a soft landing. It's soft landing. Oh, he didn't even land. Now this might be what it's like. They think they're safe. And that's not soft. Maybe some flames will pop up there soon. I think that's pretty. Yeah, that's I think where we're at. You have the slow land and then boom. Yeah, unfortunately, I don't really think we're gonna have a soft landing. I think soft landing is kind of like Bill talked about it on Thursday. It's a nice term to make us feel warm and fuzzy. Let me ask you this: if you have a slow takeoff, you can have a soft slow landing. Did we have a soft takeoff? No, we didn't. We had one of the most aggressive market takeoffs we've ever seen. Here's the S&P 500. Here's the takeoff I'm referencing, right? And it was already taking off before the pandemic's money surge. But this right here, from 2020 to 2021, this window of time right here, I'll go from bottom to our peak. To put it into perspective, that is 354 days of trading on the S&P futures. 121%. That so blows out any historical norm rate of return, right? Your average annual rate of return is 8 to 10%. Let's be generous, call it 10% per year. So you're already 10x that. There's no way. There's, for me, no way that we are going to have a soft landing. When you have that much manipulation of the monetary policy, pumping so much money into the economy, you have a Fed, like I said, I've mentioned it so many times, I'm a broken record, but a Fed who propped up the housing market, a Fed who's propped up the bond market, and then government and Fed pumping trillions of dollars in the economy, that is not going to end very well. That plane is already so high in the sky, and the engines are getting cut off right now, and it's just starting to drift lower. So hopefully you got a really good pilot, and I guess we could point our fingers and say, who's our pilot? Is our pilot going to be President Biden, or is it Jerome Powell? Hopefully they can work something out. Or is it Janet Yellen as the Secretary of the Treasury, right? I mean, obviously they need to figure something out, but I don't know. I just don't see it being that pleasant of a landing. I hope that people are prepared for it. Isn't it better to ask if it would be a V versus a W or a U or an L, right, Michael? So I'm glad you mentioned that. And I had all these questions I wanted to get to today, but I haven't got to your questions. See, you guys get me all fired up for the show. Let me... just for those I think I actually did a special on this one a while back where, there's really three types of market landings. So you have, Come on. No. There we go. So you have the classic V bottom, which is Merlin. Classic V bottom, which is where markets are selling off aggressively, and then they just real sharp bounce right back. You've got the W, which is it just kind of it bounces a little bit and then rallies. You've got the U, which is it sells off and then just kind of, well, yeah. Or do you get the L, which is so, you know, that's a great question, is what are we going to get? I don't know. I don't think it's going to be a V. Personally, I would scratch the V out. I don't think it'll be the W. I don't think you're going to see the double bottom. I think it'll be more like a U. I think it's going to take some time for this to get settled. So I personally, I think it's going to take a little bit of time for it to slow down, and then, you know, 6 months, a year till he's flat sideways and then start to get back on track. But it's going to take some time to get this out of the system. What does Shinobi say? Actually, my prediction of British pound parity isn't far from the truth. Yeah, I know, Brian. I was guess next. Hey, if it hits parity, I'm coming over. I'll buy you a beer, because since I'll be the one that has a strong currency. You vote for the W, or you hope for the W, Margaret. See, most people are hoping for that V. They want it to be very short-lived, quick, boom. I just think there's too much damage done by this cheap, easy money. I mean, maybe I'm tainted from listening to John O'Donnell for so long talk about how dangerous this is. But, you know, when I look at other economists and what historically that has done for markets, and we've been unprecedented in our spending. Nothing ever close to it in history, and we're just starting to see what the bad part is. So we'll have to wait and see. I don't know what the end will hold. All I can say is I'm hoping that my positions will take care of me during that market sell-off, and when it all starts to settle, I will have done great in my positions. All right, let me read this question or comment from Skilled Stocksman. He says, I got short the British pound at 1:30 a.m. Eastern Standard Time, put my stop too tight, but I didn't know it. Stopped that on a very huge, tiny rise after a drop. It sucks. He says, damn it, it ended up being, I didn't be too tired to make money. It was like I heard you say before, that you're always too early and right, but we still have a long way to go, and the market never ends. Yeah, the market graveyard is full of people who are absolutely right, just like Skilled Stockman was here, just a little bit too early. Man, some of the moves have happened in the last 48 hours have been phenomenal, but you know, it is what it is. You can't, don't beat yourself up over it, Stocksman. Just shake your head, acknowledge it, and okay, maybe next time I'll have my stop a little wider to accommodate it, but still got to have your stop in place. Last piece, well, not last piece, but this is Teresa, you sent this in, and I don't have the link copied, but let me see if I can copy it and paste it for everybody, because I did not read it. I'll plead that one, but I know what Al-Arian's talking about. He says, Merlin, thoughts on this article by Muhammad Al-Arian? Let me bring this one up for you guys, and I'll post it in the chat so you can look at it as well. And just when you see the headline, you'll know what I'm talking about. And I'm curious to see what you guys think about this one, but here is Muhammad Al-Arian. Yeah, here it is. And I'll post it in the chat for you as well. And basically, it's Muhammad Al-Arian making comments about the market. He says, the relentless appreciation of the dollar is terrible news. And I absolutely concur. I've been saying it for weeks. The higher that dollar goes, the worse it is for the markets. And the fact that it's surging as much as it is a real problem for us. So that's why I think we have more pain ahead. A lot more pain. I have not read through the article, but I love Muhammad Al-Arian, and I agree. I think you're going to see a lot more pain. You know, you have a couple rate announcements happening this week. Is it this week? No, next week. You have a couple rate announcements, but we're in a global currency war, right? They're raising their rates as fast as possible. Everybody except Japan. I mean, even Swiss National Bank is raising their rates, and you'll see more from Europe as they raise their rates to try to fight inflation. And, you know, it's just trying to catch up with the big pain points that they've put in place. Let's see. Question mark. I saw some question marks from KF. What do you think about Ray Dalio? He says all the time, cash is trash. Well, you need cash to transact in our current society. 10 years down the road, who knows what our transactional medium will be. If you're holding U.S. dollars, you're very fortunate because the dollar is surging against every other currency. Now, does that help you in your own country? Well, if the dollar is outpacing the rate of inflation, you could argue that it's actually the best place to be. I think long-term, Ray Dalio is right. I think that long-term, fiat currency will probably go to zero. Historians will tell you that there's never been a successful fiat currency that stood the test of time. They've all failed. Now, we've got the British pound, the Japanese yen, the U.S. dollar. Those are all competing against each other. They're all fiat currencies, but some of them are sliding pretty aggressively. If you look at the dollar's buying power around the world, it's getting better. So, Ray Dalio's right on the macro picture, but by the time Ray Dalio's beliefs come into play, I'll probably be dead and gone. I don't think you'll see the U.S. dollar die as a fiat currency for quite some time. I think it will at some point fail and move on to something else just because of our government debt and our inability to pay our debt. We'll default on it. We'll rename our currency something else, and that will be the end of it. But I think Ray Dalio is a little bit too pessimistic for me, but I do share his opinions that cash is a manipulated commodity. It is doomed for failure over time because of governments and central banks. However, right now, I would say dollar is probably the safest place to be. Especially if you're looking, I was thinking about this today. I'm going to be traveling through Europe. I was like, man, maybe I should buy some real estate in Europe, some foreign country. I can buy so much more than I could before. All right, let me see. What else do I have? Well, you guys are active today. Yep, it's great for our exports. Great for your exports, Shinobi, if you're in the UK, absolutely. Did I see last night the market price? So what you're seeing, Saba, is the expectation. I don't think Bank of England's going to raise 200 points in a meeting. They're probably going to do 50s and 75s, but they're looking at raising another 200 basis points overall. Just like the U.S. has said, we're going to raise another 125, but it won't be in one meeting, right? They're targeting another 125 by the end of the year. That means we'll get a 50 probably in November, a 75 in November and a 50 in December. And just so we can play the I watched it all go down game, let's go and bring up the FOMC Fed Funds Futures to see where we stand on that. Has it changed in the last few days? Right now they're pricing in a 67% chance of a 75 basis point increase at the November meeting, and at December, yeah, same. Oh, yeah. So they're looking at actually a 75 and a 50. Yep, just like I mentioned. Could we choose a crypto coin to replace too many currencies? Robert, that's a good question. At some point down the road, that may be a very plausible concept. Right now, the central banks don't control a current digital currency, right? They don't want that. What'll probably happen is someone, the smart one, will come up with a well-produced government-backed CBDC, and that will be the new fiat, right? It'll just be a digital currency, which is just like fiat. Ideally, we would have a monetary system that's not controlled by any central bank or by a government, albeit like Bitcoin, right? Bitcoin has its limitations and its problems, but as a concept, it's an interesting test. And I personally would much rather have a system like Bitcoin running my monetary system. Now, as a government, you wouldn't want it because you can't print more. You can't bail yourself out. You can't help yourself. Why don't they just do it in one go? The reason you don't do it in one go is because you don't know how much it's going to impact, right? It's okay. Imagine that you've got a cup of sugar, a full cup of sugar, and you got a cup of coffee. And you know you like your coffee sweet. Do you just pour in the whole cup of sugar? So now you have a cup of coffee and a cup of sugar. So now you have 2 cups and it's a 50-50 mix. That would be so sweet, it would probably blow your mind, right? So what do? You know a teaspoon's probably fine. So you drop in a teaspoon, stir it a little bit, and you go, okay, you want more. And you add a second one. But, if you do it all at once, you can't take the sugar out of the coffee. Your coffee's screwed if it's too sugary, right? So you start with a little bit, and a little bit more, and a little bit more. Because if you do it all at once, you ruin everything. And I think that's the main reason that they aren't just saying, let's just jump 125 basis points. Now, Volcker did that in the 80s, where he was like, nope, we're jumping huge numbers. But I think the situation was a little bit more panic-stricken back then. I think we're a little bit more controlled in our financial environment now than we were back in the 80s, personally. Let's see. Do you still believe cryptos will bounce before the market does, or first the market bounces and then crypto? I think the market will bounce, then crypto. I think crypto's in a world of hurt right now because as people are looking for ways to pull their capital out and get cash, if they're their first play, if you had a whole bunch of different investments and you're like, oh man, I may lose my home or I'm in financial desperation, where am I going to pull my money out of first? I'm going to go out of the riskiest stuff, which will most likely be crypto. So I think crypto is going to be beaten up much more significantly than this. All right, how far along? Holy cow, Big Eb's here, and I'm not going to go an hour today. I'm going to do one last question because I got to address this one for Lee. He says, thoughts on buying TLT. We're coming into a strong weekly demand zone. If you're buying TLT, you're saying that the dollar is going to drop and bonds are going to drop. I do not think that that's going to happen. Here's your TLT chart. I'll bring up a weekly here. There's your weekly of TLT. Oh, yeah, I see that. I mean, is it worth taking a chance at buying at 101.50? Right now you're at 103.60. You know, but basically what this tells you is that the bond yields are rising aggressively, and I believe that will continue. Could we have a small bounce? Yes. But I do not expect TLT to shoot back up to 120 or 130 or 140. It's not going to go back up to these all-time highs. No way. The main reason it's not TLT. It's because of 10-year bond. Or actually, the TLT is the 20-year, but still, you're going to have the similar picture. Here's the 30-year, right? We had this line in the sand written on here. I believe that was from Scott McCormick. Man, we're above that line in the sand, which is 350, which means we're seeking out a new ceiling, which is going to be 4%. Right, 4% is the target right now for this 30-year. That's going to hit right here. Now it's great to see the long-term bonds offering more yield, but again, this puts more pressure downside on the market. Oh, sorry. Oh man, I did it again. When I get all worked up, I'll rewind real quick. So we are going to go an hour show. There you go, Big Gab. There you go. Don't worry, guys. The chart's coming. It's probably a 30-second delay. And, man, that is a long delay for you guys to get this chart. There it is. Okay, so here is your 30-year, right? And you can see we have this line in the sand written because of Scott McCormick. You know, to me, the 4% is that next mark. And it doesn't look like there's anything to stop this 30-year. And I can look at the 10-year and say the same thing. The 10-year is well above those same levels, but now it's seeking out new highs. And, 4%'s fine, but your next stop's 4.25. After that, I mean, honestly, I think 5 is going to be your next stop, and it's going to happen rather quickly. So if that's the case, TLT, I think that you're looking at more downside move. I mean, I think TLT's next stop here is 95, and you're at 103.68 right now. You are at what some people would deem the falling knife point, right? This low that goes all the way back to 2013. I would normally say buy it. I would normally say, I'll buy some TLT. And why? Because it's just been an aggressive sell-off, and markets typically bounce after aggressive sell-offs into demand. But we're in a situation where the driver behind the bonds that TLT represents are soaring, and I don't see anything to slow that down. So is that an ascending wedge? Which one, Shinobi? Believable direction says buy SPY puts. Here, and this is something I can't say yes or no to either one of those, right? You guys have to make your own decisions. If you're buying SPY puts right now, the premium that you're going to pay is going to be much more than it was last week. And the more that the markets sell off, that premium is going to get higher and higher because the option sellers, who are people like me, I love selling options, although I don't sell that much, I'll be asking for more money. For me to take the commitment to buy those securities much lower, I want a higher premium. And unfortunately, as someone who's buying puts, you're going to end up paying it. So, right, so it's a particular trend unless you see it close above. Exactly. Yep. It's pretty darn down ugly here for these bond products. So no, I personally would not be buying TLT. If it does bounce, so let's say TLT does bounce. Let's assume it does. Where I think it's going to go, look, it might come up to this 113 mark. If it hits 120, I think you got a great shorting opportunity on TLT, not a buying opportunity. I'll be focusing there. All right, let me run through the end of this here. I have a bunch of other things I need to get to, but time is up, and I got to get out of here to do other things, get ready to go on my trip to Europe for 2 weeks. Here's your economic calendar for the 27th. Obviously, lots of central bankers around the world are making statements today, and that might have caused a little bit of jitters out there in the market. But tomorrow, you have some heavy hitting data for the U.S. This might be a little bit of a break if the data comes out better than expected. And I will highlight the ones here for you that are probably the most significant for the U.S. equity traders. You have durable goods orders coming out 1 hour before the equity markets open. You have HPI data. That's not that critical. It just tells us the pace at which housing might be slowing down, and they're expecting no change. Okay, that's good. Here you're seeing the Case-Shiller Composite 20 Home Price Index. It was 18.6% year-over-year growth. They're expecting it to slow to 17.1, which still means we're having huge moves up in prices of homes, but it's not as much as it was before. It's slowing down. But there's more. You've got new home sales, right? So we'll see how this impacts Toll Brothers, Lennar, KB Homes. You have Richmond Fed Manufacturing Index coming out tomorrow. They're expecting that to get worse. So a lot of big data, plus 2 hours before the markets open, you have Jerome Powell will be speaking. That was going to be at 4:30 a.m. Eastern Standard Time for Jerome Powell. And again, anytime that guy speaks, it creates significant waves for the financial markets. And I guess for those of you who are looking at that Jerome Powell statement there, which says 4:30 right near the top, it is a fairly important meeting in my opinion. And the reason is he's in France giving a presentation on digital assets and cryptocurrencies. So this won't be specifically, interest rates and policy. It will be stablecoins, cryptocurrencies, digital assets, CBDCs, which to me, the bigger impact from that's going to be on the cryptocurrency market space tomorrow, and see how these global leaders are positioning themselves and seeing the cryptocurrency markets going forward. Merlin, do it taste of? I don't know. I don't think so. I think that may have been shut down when the whole FTC thing happened. I'm not 100% sure what happened there, but well, I'm not leaving yet, guys. I'll be doing the chicken dance. I'll be drinking lots of beer. I'm going to weigh myself before I leave and when I come home, and I may not disclose what the results of that are going to be. But yeah, I'll do the show tomorrow. We'll do a show on Wednesday, but Thursday and Friday I'll take off, and then I'll probably be back and do a show on the 14th. I actually arrive. I think I arrive Friday morning, so I'll just do a show Friday afternoon. I'll probably be just totally trashed, but it'll be fun just to get back in the saddle. So that said, I hope you guys enjoyed today's show. All hail the dollar. All hail the king. If you guys have any comments, questions, feedback, things you want me to go over, more than happy to go into any topics, really. Just email me at TraderMerlin@gmail.com or put your comments down below the YouTube video. I have some time tomorrow to get those all collected, and hopefully I can answer all the questions, which I have missed over the past couple of days. I know many of you have said, hey, we're not answering my questions. I'll get there. No, I'm not even telling you what my starting weight is, Boss Poop, but forget it. I will definitely be heavier. There's no way I'm going to Germany and coming back lighter. It's just not going to happen. All right, everybody, thank you so much. Hope you enjoyed it. I enjoyed it. Have a fantastic remainder of your day, and I will see you all tomorrow. Take care, everyone.